probably heard a ton about the US-China trade war, but you might not realize just how it's quietly making your own life more expensive. So in the next few minutes, we're going to break down who really pays for these tariffs, how the US dollar is at the very center of it all, and why this huge global shift could end up affecting everything from inflation to your mortgage for years to come. Let's get right into it. This quote right here, this is the key idea we're going to unpack today. A lot of people think a trade war is this simple economic weapon that you just aim at another country. But the reality, well, it's way more complex. And the financial shockwave often hits a lot closer to home than you'd think. So to really understand why, we first need to get crystal clear on a really fundamental piece of this whole puzzle. What exactly is a tariff? Right. So when people hear tariff on China, they often picture the Chinese government paying some kind of penalty. But that's not actually how it works. A tariff is really just a tax, and it's collected by the US government on goods being imported into the US. Okay, so let's just follow the money for a second. An American company, say a big retailer, brings in a huge shipment of electronics from China. That same American company then writes a check for the tariff and sends it directly to the US Treasury. The money never even touches a foreign government. It's a completely domestic transaction. So the crucial point is this. Even though tariffs are used as a tool for foreign policy, financially, they are an internal thing. It's a domestic tax paid by a domestic company to the domestic government, period. And once that tax gets paid, the cost doesn't just, disappear into thin air. It has to go somewhere. It can get passed on to you, the consumer, in the form of higher prices, or the company can try to absorb it by cutting costs, which, yeah, that can affect workers. Or it can hit the company's investors through lower profits. In reality, it's almost always a mix of all three. And this brings us to the next very logical question. If these tariffs create so much pain and financial friction right here at home, what's the strategic upside? I mean, why would policymakers choose to do this in the first place? Well, the answer really lies in this fundamental trade-off between short-term economic comfort and long-term strategic goals. See, as citizens and consumers, our focus is naturally on the price of stuff today. We feel that immediate impact in our wallets. But if you're looking at it from a policy perspective, the focus is often on positioning the country for the next few decades. It's all about building economic leverage and power for the future. And here's what that long-term leverage is really all about. The goals are to bring some of those critical industries back home, to reduce our reliance on potentially unstable supply chains, and to minimize strategic vulnerabilities in really important areas like technology and defense. It's a massive economic shift. But here's the catch, right? A transition of this scale isn't fast, and its short isn't cheap. You can't just build new factories overnight, and you can't reroute global supply chains in a month. So this transitional period, the time it takes to rebuild everything, that's when costs stay high. And that is what we all feel in our wallets. Now, most of the discussion about this stuff stops right there, at factories and shipping containers. But there's a second, much deeper layer to this whole conflict that has an even bigger impact on your financial life. It's not just about goods, it's about money. For a very long time, the US and Chinese economies were kind of locked in this mutually beneficial financial relationship. It was a really stable, predictable cycle that just kept going. So here's how the cycle worked. Americans bought a whole lot of goods that were made in China. Then, China took the massive amounts of US dollars it earned from that and used them to buy US government debt, treasury bonds. So in effect, they were just loaning that money right back to the US. So why should you care about any of this? Because China's constant, huge demand for US debt helped keep borrowing costs in America low. And that meant lower interest rates for the US government, for companies, and, most importantly, for you on big things like your mortgage and your car loans. But that cozy relationship is now changing. And it's not happening through some dramatic, splashy sell-off. It's something much, much more subtle. As China's existing bonds mature, they're simply choosing not to reinvest all of that money back into new US debt. It's a quiet, gradual withdrawal. And that capital, it's being redirected. China has been steadily buying up gold reserves, which is an asset with no counterparty risk. They're also developing financial systems that don't depend on the US. The goal isn't to replace the dollar overnight, but to create alternatives and slowly reduce their dependency. Okay, let's tie all of this together and see how these big geopolitical moves actually translate into real-world impacts for you. There are three major shifts you need to know about. First, higher structural costs. Like we've been saying, moving supply chains out of China and rebuilding them somewhere else is expensive.
This means the base cost of making a lot of things is going up, and probably for the foreseeable future. This isn't just a blip of inflation, it's a structural change.
Second, we're looking at greater financial volatility. That old, stable financial loop between the US and China, it kind of acted like an anchor for global markets. As that relationship unwinds, the whole system becomes way less predictable. And that leads to more swings in stocks, bonds, and currencies. And third, a more complex interest rate environment. With one of the biggest buyers of U.S. debt gradually stepping back, U.S. borrowing costs are way more exposed to other factors. And this can lead to higher and more volatile interest rates on everything from government debt all the way down to your personal loans. You know, a lot of people are watching for some dramatic crash or a single breaking point. But what's really happening is actually more powerful and probably more permanent. This isn't a collapse. It's a fundamental recalibration of the entire global economic system. For decades, we lived in a very centralized global system. Now we're moving toward one that is more layered, more regional, and where economic decisions are deeply tangled up with strategic and political goals. So the US-China trade war is so much more than a dispute over goods. It's a piece of a much larger restructuring of global power. And in this new, more complex world, just having money isn't enough. The most valuable asset you can have is understanding the hidden systems that move it.